place to hide other than cash, says Josh Brown. That was last Friday. The worst of the excesses have been corrected in equity markets, says Oaktree's Marks. That was yesterday. There is still a lot of inflation in the pipeline, says Wharton's Jeremy Siegel. That was also yesterday. Paul Tudor Jones says he can't think of a worse financial environment for stocks or bonds right now. That was yesterday. I don't think the bull market is dead, says Hightower Stephanie Link. That was Monday. Hi, I'm Jim Dunlop, and I am a managing partner here at Advent Partners, and we're excited to have you join us for our second quarter economic update, both virtual and in person. So welcome, everyone. The point of those quotes that I opened with are all the point that we don't know. All those people are paid hundreds of thousands, if not millions of dollars by their employers to prognosticate what's going to happen in the economy. And they're all, it seems to be conflicting information. And those were just from the last several days. There is a dearth of information out there. And the reality is we just don't know. We just don't know what's going to happen. So today, what we would like to do is simply take the opportunity to share what we do know and where we have been and look at the data. And there will be data today that is very encouraging, and there will be data today that's very discouraging. And the reality is it will take us several months at the minimum to understand what's going to happen in the economy in the next several years. And the reason I say that, and it may even take longer, is that the Federal Reserve is meeting as we speak, and will announce this afternoon a decision on rate hikes. Whether the Fed is successful at curtailing inflation without driving the US economy into a recession remains to be seen. And we just don't know. And we can look at lots of talking heads, pick your favorite news source, and there will be headlines just like the ones I read. Those were all, by the way, from CNBC.com. So where we want to go today is just talk about where we've been and where we're going. Another interesting fact is that here we are in May of 2022. And the last time we had 4 negative months in a row in the stock market, my high schooler was a baby in diapers. So just think about it. It's been a while since we've opened our statements 4 months in a row to see them that negative. So it's a little unsettling right now where we are. And the worst may or may not be over. We just don't know. But let's just talk a little bit about what's going on here. So here we are. Oh, let me just switch this here. All right. Here we are, the S&P 500 at index at inflection points. And the S&P 500, as a reminder, is the 500 largest capitalized stocks in the US economy. So here we are going back to 1996 and several market cycles. And if you've attended or listened to this presentation in the past, you have seen this chart. And we keep adding to it. Now, this goes back, this is as of April 22nd was the date we had to pull all this and send it to our compliance for today. So it doesn't include the last week's worth of data, but it's still pretty close. And so what we're seeing is a little bit of a market pullback, but nothing on the magnitude of what we experienced 2 years ago during the pandemic, and certainly nothing like we've experienced in previous recessions. So, but it is certainly a more than noticeable blip. But let's talk a little bit about sure this is my clicker is working. There it is. Good. All right. The S&P 500 valuation measurements. Now, this is a chart that I like a great deal. And what we see here is the middle dotted line is the long-term average of the earnings of the S&P 500. So their corporate earnings. And historically, the S&P 500 trades around 16, maybe closer to 17 sometimes, its forward earnings. So right now, we have seen a stock market, if we look back over the last 2 decades here, that has moved in and out of its long-term averages. And And coming out of the pandemic, we posited that stocks were pretty overpriced. That top dashed line and the bottom dashed line represent kind of a normal range of where we would expect earnings to be. When we get above that line, what we're experiencing is stocks might be overpriced or expensive. When we get below that line, stocks may be cheap. But when we get close to the center line, we would say historically stocks are probably reasonably priced. And we feel like perhaps we're in a place where valuations are more normal and less inflated than we saw even 5 months ago. So that has been encouraging. So stock prices have gone down, earnings have come up, and that has created a place where stocks could be more reasonably valued than we've seen in quite some time. And then let's pull that apart a little bit further. If we look at the left, the green line is the top 10 biggest stocks, and the gray line is the remaining 490 largest stocks in the country. And the top 10 historically traded about 19 to 20 times earnings, and right now are at 27 times earnings. So that top layer of the stock market, which by the way accounts for about 20% of the markets. So it's the really big companies, Apple, Microsoft, Amazon, Tesla now is in that list, Google, Berkshire Hathaway, Johnson & Johnson. Those stocks probably are a little frothy, but if we look at the remaining stocks, they're at their historic average is about 15.7 times earnings. They're at 16. They're about 107% of their long-term average. So probably close to their fair valuation. And again, if we look at here on the right, those top 10 stocks make up 29% of the S&P 500, and they account for about 23% of its earnings right now. So again, I want to put some perspective on where we are. Everybody, I think, may be familiar with the tic-tac-toe board, but we like to break stocks into 9 categories. We have large stocks, we have medium-sized companies, and we have small companies. And then we have value companies, we have growth companies, and then we have what we call blended or core companies that kind of have characteristics of both. So stocks fit into one of 9 categories. So that's why we see all these tic-tac-toe boards. Year to date, which is the center upper tic-tac-toe board, we can see that large cap stocks as of a week and a half ago were down 10%. They're down a little bit more since then, but not dramatically. And we can see that if we look at our small cap stocks year to date here, and I'm going to try to point using the pen here a little bit. We can see that our small cap, particularly our growth stocks, are down a great deal here. So growth and small companies have suffered a little worse than larger companies going forward. But if we go back to the peak of the market pre-pandemic, so February 19th of 2020, stocks are all still, and that's this chart here, all categories of stocks are still pretty significantly higher. And if we still focus on the long-term 10-year average, we have double-digit average annual returns, even in this current environment over the last 10 years. So that's certainly an encouraging place. Also, a little perspective on the last 4 months. What we're looking at is going back to 1980, and it's the S&P 500 annualized returns for each of those years. So the gray bar is what the market did. Most years, the market makes money. Obviously, in recessions and in bear markets, it loses. The red dot is the lowest point that index was during the year. So for instance, we can go back to the late 90s and we saw some pretty big drops in stocks similar to what we're experiencing, yet double-digit returns on the year. And so you can see some really nasty drops, and those are represented by the red dots in positive years. And of course, we see really nasty red dots in some of the bad years as well. So stocks have lost money in almost every year for the last 40 years or 42 years, but have made money in a majority of those years. So what we're experiencing now isn't that far out of the realm of unusual when we take a historic perspective. Want to talk now a little bit about economic growth. Now, since this chart was published, and it doesn't change this chart, but we learned that in the first quarter that GDP, which is the measurement of growth in the United States, declined unexpectedly. Now, you can go on TV and you can listen or read the paper, and there will be people telling you, hey, look, this is the trend, this is start of recession. And then you have others, oh, this is one-off, it's a blip, it doesn't count. We don't know. We do know that growth surprisingly contracted a little bit here in the first quarter. But what I like about the chart on the left is just showing us that we are kind of getting back to where we were, what the type of growth we were experiencing pre-pandemic, kind of getting back into that long-term trend, and we're there. The chart on the right is just the components of GDP, and I think it's important to note that, again, the largest component of GDP is about 68%, or 68 to 70% of gross domestic product, economic activity in this country is consumer spending. This is really important, and keep this in the back of your mind. We will point this out as we continue forward here today, because this will come up again. The consumer is still the largest driver of economic activity in this country. So just thinking about the pandemic, I thought this would be helpful to see some good news and bad news. I think the bad news is that we're seeing an uptick in COVID again, but the severity seems to be a lot less. And so the mortality rate, that's the blue line, is COVID cases, and we can see it starting to arc up here over the last few weeks at the very right end of the chart, but we're seeing the death rate continue to go lower. Now, that can lag COVID cases, but it seems that COVID is less severe. Hospitals are better equipped to treat people who show up with it. And so that's a good sign. I think that gives us a lot of confidence that the economy will continue to recover. On the right is just high frequency data that JP Morgan tracks just to determine what current economic activity might be looking like. And what we're looking at is these high frequency things going back before the pandemic. So that top gray line on the right is consumer credit card transactions. Keep in mind, JP Morgan is one of the largest providers of credit cards in the United States. We can see that it's worse, that credit card spending had dropped 34% at the worst part of the pandemic, going back 2 years, but currently is actually up 29% since February of 2020. So consumer spending has rebounded significantly since the beginning of the pandemic, which is good because it's the most important driver of our economy. Hotel occupancy and US seated diners, people going out to eat, and again, TSA traveler traffic data, those are still a little behind their pre-pandemic or the 2019 averages during the third week in April of 2019. So they're actually going back 3 years to what we would say normal. And we can see occupancy is down slightly. People are a little less out to dinner, but not dramatically. And then of course, traveling is still down. We are certainly hearing from the airlines that there's a lot of intended travel this summer. People have booked a lot of flights. Airplanes appear to be full at the moment. And so that consumer activity may continue to pick up. And the next piece of data I want to share is our federal finances, which is sometimes, I apologize to those of you here in person because you're eating, and sometimes this can be a little stomach turning, but on the left is the money that the US government will spend in this fiscal year. And on the right is the amount of money it will bring in taxes and other things. And so we see a 1.1 trillion or 1,000 billion deficit this year. And so that will be, that will increase the federal debt. So in the upper right-hand chart, we can see that our deficit is dropping from what we saw in 2020 and 2021, being back to a more normal deficit, but it is still a deficit. And then the bottom right is the complete federal debt. And of course, as measured against our economy, at the end of last year, we were almost at 100% of GDP in terms of debt, place we really haven't been since World War II. And the trend is that that is likely to not go down because we continue to deficit spend. But those are just projections and we just don't know what the future will bring. But it certainly has the potential to be create economic challenges of its own over the next decade as well. We'll talk about the consumer a little bit more. And just as a side note here, and I forgot to say this at the beginning, the information that we're seeing here comes to you from JP Morgan. JP Morgan is one of our financial partners that provides a lot of research and data to us. We do use some of their investment products in our portfolios from time to time. And so we really like their data set because it's updated literally every day and available to us. And so we think that's a really helpful. Just to put a little perspective, again, on the last 20 years, on the left is the accumulated amount of US consumers' balance sheets. So the US, if we took all of our net worths and stacked them together, we're worth $162 trillion. 25% of that is equity in our house, 9% is money in the bank, 19% is pension funds and retirement funds, and 42% is other financial assets. On the right is our total debt as a country, and it's only 18 trillion against 162. So, and most of that's people's mortgages against their houses. Just to put it in perspective, right before the last recession in 2007, so go back to the third quarter of 2007, on the left, we were all worth a collective of $85 trillion. So we have almost doubled the net worth since before the last recession. And we were worth 73 trillion at the worst moment. That was the first quarter of 2009, where we bottomed out and started the recovery in that recession 14 and 13 years ago. So again, consumer is pretty healthy now, both from a historic perspective and currently. Now, on the right, if you will look, household debt service ratio. So how much of my income on average is going to debt service? In the fourth quarter of 2007, right before that recession, we were at 13.7. Today, we're at 9.3. Now, we dipped down closer to 8%, but we're still at historic lows. You have to go way back. If you go back, this chart starts in 1980. The average consumer was putting 10% of their income toward debt service. It peaked at 13%. It's still actually around 9% today. So again, the consumer overall is healthy. Now, we could parse that down and say, yes, there's people not doing well, and we know there's lots of people living paycheck to paycheck. But broadly speaking, we know that we're doing well. Now, on the right, bottom right is what we'll call flow of personal savings. What's the average amount of income that people are, of their disposable income, are they putting to savings? Obviously, that spiked in 2020 and 2021. People weren't spending money. We were getting federal stimulus. A lot of people just saved it. And that savings rate has actually dropped, but it tells us that the consumer is still spending probably a lot of pent-up demand around travel, things around the house, things we couldn't do during the pandemic. So spending is still strong, and that's an encouraging sign because, again, it continues to be the biggest driver of economic activity in the country. Again, thinking about the consumer, we think about the worker. If we look here, this is the rate. The unemployment rate is the dark line. The blue line is the wage growth. And those tend to work diametrically opposed. As wages go up, unemployment comes down, or vice versa, or you could say it the other way around. And then as unemployment goes up, wages go down. And so obviously we had this weird spike during the pandemic of unemployment. We're back down. But again, we're at unemployment rate right now. The long-term average is 6.2% at the end of last month. It was 3.6%. So a very low amount of unemployment, and wage growth is around 4%. So again, workers, their jobs plentiful, workers are seeing increases. Obviously, there is inflation going on, and we'll talk a little bit about that as we go along. But this is a good sign, again, for our economy, in that we have a pretty, high level of employment, which means people have money to spend. So let's talk about inflation. I think inflation is probably the most important thing markets are paying attention to. And the reality is, we know where we've been, but we don't know where we're going to be. We don't know if the Fed is going to be successful in reining in inflation. They will try, and there are lots of people out there saying they're too late, they're too soft. There's people out there saying they're too aggressive. And then there's, good old Jim Cramer saying they're just right. So my point is, we don't know. Nobody knows, but here's where we are. So we'll talk about headline and core CPI. So headline is overall inflation. Core CPI takes away food and energy. Is that good or bad? I'll let you decide for yourself. The reality is the numbers long-term are very close. The reason core CPI, consumer price index, strips out food and energy is they tend to be incredibly volatile, and so that they can really skew the line. And if you look at the blue line, it moves around much more wildly over time than the gray line, times when oil prices spike or drop, when food prices spike or drop. But here we are today, and what we can see is in February, headline CPI was 7.9. In March, it was 8.6. It's a little more there at 6.4. Both well above their long-term averages. So we see both those lines. That dotted line across the middle of the page is the long-term average. And really, we're going back 30 years at this point since we've seen a spike like this, and really closer to 40 years since we've seen anything like this. So what will this look like? Will it look like 1990 with the Fed will rein this in and get inflation under control quickly? Will this look like the early 70s or the late 70s? We just don't know. We just don't know. But the Fed is going to try to address this without damaging the economy, and they're walking a fine line. So here's an interesting chart that I wanted to share, and this is the components that make up inflation. And there's 6 broad categories here. There's energy, there's new and used vehicles, there's food at home, there's the other, which is household furnishings, apparel, medical care services, kind of everything else that doesn't fit in the broad categories. Then we have blue, the hospitality and travel, restaurants, hotels, and transportation. And then the dark blue at the bottom is shelter. If we look at any of these colors, we can see they're all higher. Now, what's interesting about this chart, and JP Morgan, the data comes from the Bureau of Labor Statistics, but JP Morgan put this little commentary here and says, energy, vehicles, and food are all 3 of those categories. And that's food at home. That's groceries we buy. Restaurants are obviously in different categories. Those are probably maybe transitory, meaning there's parts of this that are probably temporarily high that'll come back down. But then there's the stickier, and that's these bottom 3 components, the other catch-all category, but restaurant, hotels, transportation, and shelter. Those prices probably aren't as likely to reduce. So it'll be very curious. But again, we've seen inflation really build since March of 2021 over the last 12 months, and we can see that it continues to ramp up. So let's talk about the Fed. So the Fed's got 2 ways to combat inflation primarily. One is their open market activities. Historically, they've been buying a lot of bonds and that has helped. That's the equivalent of putting money into the economy. And then they also control interest rates, which they lowered during the pandemic. So we can see they had begun in 2016 to start to gradually raise rates. And then here we were at the pandemic, and they dropped them essentially to 0. And now we're trying to figure out where they're going to go. What's interesting is that the market is the green line, and then the Fed is the dark blue line. So the Fed says, this is where we think we're going to be. The market says we think you're going to be a little bit higher. The market has historically tended to be a little more accurate than the Fed in its own projections. But long term, the Fed expects its long-term rate to be around 2.4. But what we are seeing is over the next 2 years that the rates will get probably near 3% from 0. How quickly and how gradually the Fed engages in that process will be very key going forward. And we will see some indication of that later this afternoon, quite frankly. And I think it's at 2 o'clock, the Fed will make its announcements on interest rates. By and large, a lot of people are anticipating a 0.5% increase, which they've typically done 0.25% jumps. So to do a 0.5% is a little more of an aggressive move. It'll be very interesting if it's higher than that. And it'll be interesting if it's lower than that. So we'll wait and see. The Fed doesn't tend to offer too many surprises. And so I think there's a good chance it'll be a 0.5%. And that's essentially, as I explained to a client of mine who's a doctor, I said, look, it's they're trying to figure out the right dosage of medicine right now. Too much, you hurt the patient, not enough, the patient doesn't get better. So the Federal Reserve also has its balance sheet. So it spent the last really 15 years buying a lot of bonds. It did that and has held those bonds, both treasuries. So it's buying the US government issued debt, but then also what we call mortgage-backed securities. So a lot of home mortgages. And they've held those, and what the impact that has had is it's put more liquidity into the economy. And now they're going to likely, they announced here in March, they're going to stop buying and start selling. And so the Fed balance sheet will start to decrease as they start to put those bonds back in the open market. So it'd be very curious to see, again, the impact of interest rates, and also when they sell bonds, they're essentially pulling cash out of the economy at the same time. And so tightening things, we hope will rein in inflation. And they hope will rein in inflation. I also thought it would be helpful to look at a little bit of history of when the Fed has been hiking interest rates, what's happened. And we've had we've had about 6 cycles in the last 40 years of Fed tightening or rising interest rates. And what's interesting to me is if we go to the last 6 cycles, and we go over to the right side, on average, they raised 2.9% or 290 basis points. The 2-year Treasury on average came up 228. The 10-year came up an average of 1.17. So those Treasury rates follow Treasury yields follow the federal funds rate to some degree. The S&P 500, though, interestingly enough, during periods of still went up an average of 5.8%. So a lot of the fear in stocks is the Fed starting to take and tighten monies means that there's less money to put in stocks. And so that has caused the markets to be unstable and even go down this year, because tightening leads to the thought that a lot of what has driven the stock market up was people had extra money to buy. There was no other place to get a return. But if we look at the history here, the stock market has continued on average to do well during that tightening cycle. Now, that's not always been the case. It didn't happen in the early 80s. It didn't happen in 1994, but it had some dramatic returns in other tightening cycles. So we'll be very interested to see what the result is. But just because markets are selling off because they think interest rates are going up doesn't necessarily lead to long-term devaluation in stocks. And then talking about interest rates and inflation. So the 10-year Treasury is an important rate to follow. And it's important to follow because so many financial products are pegged to it. Most mortgage companies and banks peg their mortgage rates to the 10-year Treasury. A lot of CD yields at banks are pegged to the 10-year Treasury. A lot of financial instruments, insurance companies set their actuarial tables and their cash reserves based on 10-year Treasuries. So the 10-year Treasury yield is the most important watch thing. And the yield is the net impact of when the Fed sells a 10-year Treasury, or excuse me, when the Treasury sells a 10-year note, what it's doing is the yield is, if it offers a 3% note or bond, and then it gets discounted, or it gets a 2% premium on that sell, that's a yield of 1%. So they're selling it at 2% premium to make, people will pay 2% to make 3. So the net is the yield. So the point of that is that we saw yields during the pandemic dip below 1% for the first time in modern history, you know, and they've been coming back over the last year, and that's been a little bit painful because bond prices and yields are inversely related, and we'll talk a little bit more about this. But it's been a difficult time for bonds. Stocks did really well last year. Bonds did very poorly. Bonds continue to do poorly, although I think we're closer to the bottom of the bond issue, and we'll talk about that, than stocks. But what's interesting is the 10-year Treasury is also considered the most safe investment in the world. Now, we can all debate whether we agree with that, but it's still the risk-free asset class. And what we have historically seen is the gray line is the yield on the 10-year Treasury less in the inflation rate. And so people right now are willing to take a 3.5% loss for safety. And so what we're saying on April 22nd, if we took the yield on the 10-year and subtracted the rate of inflation, we can see a pretty dramatic shift that we haven't really seen since the 1970s. So people are willing, for safety's sake, to give up any sense of return. In fact, they're willing to lose real dollars and spending power based on this. So, but it is somewhat encouraging to see the 10-year Treasury go back to slightly normal rates. It's a little bit of a painful rotation for bonds, but it's also probably closer to where it's been. The long-term average is actually 5.8, but if we look at the last decade or two, 2.9 is not a bad place to be, although inflation is higher. So let's talk about bonds. Our conservative investors have been, it's been very frustrating because it's last year we at least made money in stocks, but we didn't make much in bonds. This year, stocks have lost, bonds have lost. What I would argue, and what this chart is showing us, is that I suspect that the bond market has priced in most of the pain of interest rate hikes already. So we'll start with the chart on the right, and it shows all the different bond instruments. So the first 5 categories are all treasuries, securities backed by the full faith and credit of the United States government. So the 2-year, the 5-year TIPS, which are inflation protected securities, they're even down. The 10-year, the 30-year, all those are down. And the 30-year would say that if the rise in interest rates is 1%, a 30-year treasury on average drops about 17.8%. Now, if we look over at the chart on the left, we can see year to date that the 30-year treasury is down 20% already. So if you were in long-term treasuries, that's been a very painful ride. Most people aren't, by the way. The people that are holding them tend to be insurance companies and other places that are holding them to maturity for long periods of time. But the point in this is that we think that the market has probably likely baked in most of what's going to happen this year for bonds. So I think there's a good case to be made, unless the Fed deviates pretty dramatically from what it's suggesting it'll do, that bonds may be close to their bottom. Now that we don't know, but I think there's certainly an argument. I think stocks are a much harder thing to know. We saw at the beginning that stock valuations look more compelling than they've looked in a while, but I would also say that it's, we just don't, there's so much uncertainty, and markets could care less about earnings in the face of dramatic uncertainty. And so, but I think the bond market hasn't gone down relative to uncertainty. It's gone down relative to interest rate increases and the anticipation of those. And so we would like to think, and we're hoping for more conservative investors, that the second half of this year will feel a lot better in that most of that damage, hopefully, in this market has been done. Now, obviously, if inflation roars way out of control, all bets are off. And then we just look at the yield curve. We hear this idea of the inverted yield curve, and every time we've had a recession, typically it's that's preceded in the 12 to 24 months before recession by an inverted yield curve. The yield curve is slightly inverted right now, and if you look at that blue line, we would see that the 30-year rate is 2.95 and the 20-year rate is 3.14. So when the longer durations are lower than shorter term, saying I can make as much money in 2 or 3 years in a treasury as I can in 30, that tends to be that. But let's be clear, that doesn't always, it's not a perfect indicator. It's certainly a warning sign, but there are many, many indicators in the market. So it's hard to get terribly excited about that. And then again, this is the, when we look at all the different asset classes in bonds, and I can go into details of what they are, but what we're looking at is the gray bar and the range of those valuations for bonds. And the purple line is the 15-year average. And so we're seeing, and then that kind of diamond is where they are today. And so a lot of cases, bonds are close or below their long-term average, but probably closer to the bottom than the top. And so I think that again is encouraging that bonds may be close to the bottom of their pain point at this point. So we remain hopeful there. Just a real quick looking overseas on the left is global growth earnings, which is just a very interesting thing. And we have 3 years in a row. We have 2020, we have 2021, and now 2022's projected estimate. And what's interesting there is that 2021 was a big year, surprisingly. Obviously, 2020, we saw a lot of negativity, but there's still a consensus for estimated growth in 2022, albeit probably more normal and more normalized. What will be interesting is to see what happens in China right now. I think a lot of us they're back to the lockdown game pretty severely in Shanghai, and what impact that will have on the Chinese economy is very, I think, concerning. It's obviously it's one of the largest economies, and they've essentially shut themselves down trying to combat COVID, and certainly their case counts are coming down, but they have a large amount of their seniors that are unvaccinated, and so their death rate has been troubling. And they're taking a different policy approach than we would or have in the United States, but I think it has the potential to significantly damage their economy. Not sure what that means for us. Nobody knows, but it's certainly something that we're watching and paying attention to. And then if we look here, the idea of diversification, and I think want to just compare some broad categories for you, just to put some perspective on where we're at. In the first set of bars there on the left, the green is the range of stocks in a 1 year. And so going back to 1950, in its best year, the S&P 500 returned 47%. In its worst year, it lost 39%. Bonds in their best year made 43%, and in their worst year lost 8%. Again, if we look at a historic perspective on bonds, we're probably at the worst moment that we've seen historically. And then the gray line is if you had a portfolio that was 50% S&P 500, 50% aggregate bonds, what that would have done. And that diversified what we would call a moderate portfolio, and its worst year lost 15%, best year made 33%. But then when we go out to the 5-year rolling averages, 10-year and 20-year, we can see that most of the time, any losses in a 5-year was very minimal, and only one time did we over a 10-year period lose 1%. And that was from 1998 to 2008. And so, but by and large, things do well. So my point in this is time is the great equalizer and reduction of risk. So we know that in 1 year things can be pretty wild, but as we go further out, so investing continues to be a long-term prospect. So in moments like this, which feel like what we're seeing on the far left there, down below the line, to keep in mind that time is the great equalizer. And this is going back to 1950. So this is a pretty broad cross-section there. Some other things around diversification and what JP Morgan describes as the average investor. Across the bottom, you can see the 20-year average annual returns in all these different categories of investments. Now, the green bar is the S&P 500 stocks, 20-year average is 7.5%. This was as of last Friday, so this is pretty current. They would also say that a portfolio that was 60% stock, 40% bonds has a 20-year average rate of return of 6.4%, and a slightly more conservative that's 40% stock, that's this dark blue line, and 60% bonds has averaged about 5.9%. The average investor, and I think the way they measure this is the amount of money in and out of mutual funds averages 2.9%. So when the average investor is emotionally deciding on their money, they're probably selling low and buying high. They're jumping out of stocks at a time like this when they're scary, and getting in too late when they've recovered. And so the idea of staying diversified over long periods of time is probably one of the best predictive things. We could be very super aggressive and say REITs, which is that far left category of average 10% over 20 years, that's real estate. And we all know over the last 20 years, the roller coaster that real estate has been and continues to be. And then the next category to it is emerging market equities have done very well, but they have been very much a roller coaster. And then, we see some riskier categories have done well over 20 years, but as we get a nice diversified portfolio, we really reduce a lot of risk. So that concludes the content here. I do want to take some questions if anyone has them. There are several definitions, many definitions, in fact, of all the different indices that are used in this presentation. And it's important from both JP Morgan and Thrivent would also like you to know some important disclosures here. And what they're saying is, look, we are sharing data that we know and that we believe to be accurate, but investing contains risk. And here are some other indices that you might want to understand what they are. So I appreciate your attention this morning. And I'll conclude and just say this, is that the bottom line is we don't know. The consumer still looks strong. The consumer is an important part of our economy, and that's an encouraging thing. Inflation is not under control yet. And so that's also a discouraging thing. And I think what we're seeing in the markets is uncertainty. Markets hate uncertainty. We didn't even touch on Russia invading Ukraine. That has created another layer of uncertainty, particularly around energy prices. But I think the bigger issue continues to be, will we get inflation under control? If we do, that's a great place. But if we push the economy into recession because we raise rates too high too quickly and the economy goes into recession to fight inflation, the market's worried about that. The market's also worried about if we don't act quickly enough to raise rates, that we could go through a long and more difficult period like the 1970s. And looking around the room, I'm guessing a number of you remember that. I think the term we keep waiting to hear is this idea of soft landing. And that is kind of splitting that gap of not getting the country into recession while getting inflation under control. That's certainly what the Fed is attempting to do. And we won't know if they're successful for a while. Okay, we can listen to whoever we want, say what they think is going to happen. The truth is we don't know. And markets are proving that point. Markets like certainty, and in the face of uncertainty, markets tend to go negative. As we get more certainty in the months and quarters ahead around what the Fed's doing, the market could level out. So the Fed announces at 2 o'clock, just a little bit of interesting data point. On March 16th, the Fed did its first interest rate hike. So that was 6 weeks ago, I think, 7 weeks ago. And they did a quarter point, and the market stabilized. Actually, the markets rallied back a little bit at the end of March into the beginning of April. That was really encouraging. And then, of course, in April, the market sold off again. And so it would be very interesting to see. I'll be curious more than anything to see what happens to stocks following the Fed's announcement today. Certainly things could level off and stabilize for a few weeks. They could stabilize even longer than that. But we could see some positive signs in the market coming out of this, but then we could also relive what we did over the last several weeks, which is a little bit of relief in the markets and then dropping again. I think there's just a lot of uncertainty. And while I feel a little more confident about where the bond market is headed, based on the fact that most of the interest rate hikes seem to be baked into it already, I don't think we have a lot of certainty around stocks. So thank you very much for being here today. Does anybody have any questions or comments? And I'll look and see if any pop up online. Well, hearing none, thank you so much. We plan to be back here again, the world allowing, back at the first week in August. So we like to do these every quarter. We like to do them the first week of the second month. That's when we have the best kind of trove of data from the first quarter available, but still timely enough that that's kind of our timing reasoning there. So would love to have you back with us, either in person or, if you can't do it, virtual. And our plan is to also record these and post them to the website. So if you're curious to hear what we have to say, but can't make that, you should be able to log into our website and look at that. So thank you very much, everyone.
Thank you.